Okay, Q&A. In a stagflation economy, would R be greater than G? Well, that depends on what the central bank would do. Government debt would have a positive carrying cost, and the Fed would be able to decrease R. So in the video for R and G, R we used a 5-year rate. G is the rate of inflation because nominal GDP will increase at the rate of inflation. And that means tax revenues, if you hold tax revenues as a percent of GDP constant, tax revenues will increase at the rate of inflation as well. So if we think in a stagflation economy, you have, let's say, inflation falls to 6% from the 8-point-something% we have now, you would have to have the 5-year rate greater than 6%. So you would be looking at another 250 300 basis points higher than where we are to get above that number. Now, if you did have a situation where R was greater than G, then you are right. The government has a positive carrying cost on their debt. This would then cause them to be a little bit more cautious about how much money they spend. So you would then see some fiscal pullback. Maybe that's what you need to put discipline into government spending. Because if you tell a bunch of politicians, hey, R is less than G, which means our debt has a negative carrying cost, everyone starts thinking about how they can buy votes. You know, my district needs this, and it needs that, and it needs this, and I'm going to buy myself my re-election by doing that. Then you have more and more and more and more spending. So maybe to fix the spending that's coming out of our politicians, maybe you have to have the debt that costs money. Maybe that won't slow them down, and maybe that'll just destroy the country faster. Maybe we have to look to our central banks for responsible government. Michael McKee on Bloomberg said that the unemployment rate went up because participation went down. Yeah, I did hear him say that, and it caused me pause, and I said, what? No, that can't be. That doesn't make sense to me, and you're right. I think he just misspoke. I thought the two were positively correlated. Can you shed light between unemployment and participation? So the unemployment rate we get from the household survey, because you can't ask a business, how many people do you not have employed? So you can't get any measure of the unemployment rate from the establishment survey, because a business can only tell you who it has hired, not how many people it hasn't hired. So that comes from the household survey. The household survey showed a drop of 306,000. That's why the unemployment rate went up, even though the participation rate went down. So participation rate going down would lower unemployment. However, lost jobs raises unemployment. That's why unemployment appeared to go up, because it is derived from the household survey, not the establishment survey. And we look at the establishment survey for the number of jobs created in the economy because, well, an establishment either hires or doesn't hire. We find it to be a cleaner number. Why did the Fed return the coupon payments back to the Treasury at the end of the year? Because the Fed is a government organization. They are part of government. They are separate but part of government. And as such, it's not their money. It belongs to the government, and all that money goes to the Treasury. The question is whether they want a job. This is sort of more of a social issue here. It may need to fit their specific schedule or be very flexible. For example, mothers that have a newborn, high schoolers that are in sports. Maybe the employers are more demanding on their availability, and the employees are more demanding on flexibility. So, this is probably in answer to the question of why the participation rate is so low. That it's structurally low at this point, probably not going back to that 65, but probably at the 62 for a while. And this person is saying, well, could it not be that what employers are asking for, the sacrifices employees are asking for, are sacrifices that people are no longer willing to make? And there could be a case for that. The pandemic gave everyone a taste of leisure with a paycheck. Work from home is, well, it's not really work from home. Okay, it's more like I live at home and work happens here. And then if you work at home long enough, it's, look, I'm at home and work keeps getting in the way. So once you have to go back to work, you think, I've had this taste of economically supported leisure, economically supported freedom. I don't want to give it up. I don't want to go back to work. And if I have to go back to work, I don't really know if I really want to sacrifice 40 hours of my week anymore. There could be something to that. However, there is an economic reality to life, period. You can decide that no job wants to meet your schedule. You're simply just not going to work. You're going to withhold your labor. Well, they will withhold the paycheck. And at some point, you're going to find that leisure without money is not very exciting. When you see everybody else enjoying a certain type of leisure because they have a job and a paycheck to afford the type of leisure that they want, you don't. And then you've got bills to pay, things to do. You've got to live, you've got to eat, you've got to wear clothing, you've got to raise kids maybe, you've got a family, you've got responsibilities. Well, at some point, economic reality will grab a hold of you. So there is something to the idea of, I've had it really good for the last couple years. Now I got to go back to the way it was before. It feels like I'm losing something and I don't want to lose that. That will fade over time as you get closer and closer to poverty. Poverty is always a great motivator to encourage people back into the labor force. So yeah, there could be something that people are, saying, you got to respect my leisure time and I'm going to give you so much. And then you got to balance that with, like I say, the economic reality of getting through your day. My question is about cost push inflation. Monetarists argue that inflation is always and everywhere a monetary phenomena, and rising critical input prices, such as oil, energy, will not result in persistent inflation. It will only increase price level, and then the inflation rate will be the same. All right, let's stop right there, and let's put this in context. Monetarism is a school of thought. It's a theory about how we can view inflation. And from it, we can draw some conclusions that would be good advice for policy about how we would deal with inflation based on their theoretical assumptions of why inflation comes to be and the nature of inflation. And to determine whether those theoretical assumptions are worth paying attention to, you would see if your theory fits the data, and it fits the data quite well, but so do other theories of inflation fit the data quite well. So it isn't as if there is just one big theory and that's it, but monetarism is a fairly significant one. Keynesianism being the other big one. So this is saying, and it's also making the assumption that a supply shock doesn't have a growth component to it, or a negative growth component to it. It just simply happens and then it's over. So if you have a price of something that's at a certain level and there is a shock and that price level jumps, this is what you would have, a higher price. So if you were measuring inflation at this point, you're measuring this price over this price, that's a lot. The next month you're measuring this price over this price, inflation is coming down. Notice the price difference is starting to come down until the base effects wear off and you're measuring this price versus this price. You'll note that you have 0% inflation, just a persistently higher price level. Well, what happens if the input that you're using, first of all, the input has to be broad enough to affect prices in the economy as a whole. What happens if the input that you're using continues to contract in supply? Well, then you wouldn't just have a one-time jump. You'd have something like this, and you'd have this kind of thing going on. The one part I think that is left out of the argument over here is that if you have a supply that is shrinking at a negative growth rate, not just a one-time shock, but an ongoing structural shrinkage of a particular input, is prices have to keep rising. And if prices keep rising, and the worst one shortage to get into is a labor shortage, and which is what we have right now. Prices keep rising, so the cost of living goes up, which means that the employee goes back to the employer every year and says, you got to pay me more money, not because I'm worth more, but because everything costs more. or I'll leave. Well, you have a labor shortage, so you got to give them the money. And then you think, well, I'll just pass it on to my customers with a higher price. Next year they come back to you saying, you got to give me more money, not because I'm worth more, but because the prices are higher. If you don't, I'll leave. Well, you got a labor shortage, you got to give it to them. You pass it on to the customer. Next year they come back, they say, hey, you see what I'm saying? You get this wage price spiral. So you can get inflation rising through nothing else other than its own momentum. If you have a one-time shock, you have this. If you have an ongoing shock, you have something like this. And after a certain point in time, it becomes a self-fulfilling monster on its own, in the sense that one will feed the other, which then feeds back into the first, which then feeds the other. You have to break that cycle before it happens. That's called, as I said, a wage price spiral. Once that gets a hold, it's hard to break. Because if I'm used to 7-8% raises every year, I'm going to find it hard to go back to 2 to 3%. Even if inflation goes away, I'm still going to say, look, I've been getting 7-8% raises for the last 2-3 years now. Suddenly I'm only going to get 2 or 3%. I'm out of here. Because you get accustomed to what you get. We tend to grow into the size of our paycheck. So if we make $100,000 a year, we'll live on $100,000 a year, and we'll say money's tight. We get a job at $150 a year, we will grow into that income, and at some point we will say money's tight. That we can't even imagine a life at 120, which would have been better than 100 when we were at 100, only because we grew into it. That's something that you have to break before that begins to get a hold. Jerome Powell referred in the press conference that the Fed looks at the Fed forward rate. Well, it looks at a forward rate. I don't know if I'd call it the Fed forward rate. Maybe he refers to it as that. Instead of the market conventions, 2 to the 10, 3 to the 10. Could you explain exactly what the Fed forward rate is? Yeah, so you can look at the market today. This is where we are today, and you can look at a 3-month T-bill rate, and let's say that it's X%. Then you'll go out 18 months and you'll look at what a 3-month T-bill rate is there. That's called a forward rate, and you have to calculate that forward rate based on rates that you see in the market. So you'll have a 2-year rate, you'll have a 1-year rate, we've got a 6-month rate, and with some math, you can calculate what this forward rate will be, this 3-month forward rate will be in 18 months. And we'll call it Y%. And then it would simply just be X minus Y%. Whatever we observe today, this 3-month rate, minus what this rate is, what this 3-month rate is expected to be in 18 months. And if that is inverted, that is the signal they have for an impending recession, that is always inverted as well. But so is the 3-month 10-year. That has a 100% record as well. So you could just do it that way. All right, 3 questions here. First one, Peter Zeihan, September speech for ECC, mostly talked about the global supply chain, the effect of Russia on Ukraine war on it. Some of the problems mentioned sounded really horrible. Yeah, he can do that. What's your view on that, and could you help us? Is this situation the worst we have ever seen? So what I find that he's very good at is laying out the problem and his data. However, from there he gets to conclusions that are far too fatalistic for me. It always is in terms of some country completely disappearing this decade, or some country completely collapsing in the next 3 years. And it's like, well, you know, I'm not going to listen to your conclusions. That's where you got to, and I think that's why people listen, is because it's so, shocking. It's like, really? But the data, the front end part of the argument is pretty good. About the ETF PIC, P-I-C-K. Since there's a high probability of recession in the world, doesn't this mean that the demand for raw materials will be lower and eventually it will hurt the top line? I completely agree with your view that this electrification and going green trend is really important. A lot of mining companies would profit from it, but in aggregate, what would happen? Yeah, so the industry has some near-term problems. That's why the prices are where they are. That's why they're so cheap, is because the investment community recognizes that this industry is probably going to be under pressure for a while. And if you have to beat a benchmark, or if you have to have an absolute return, there's no point hanging out here. Even though you could generate some income here, there's no point hanging out here. I tend to buy stuff that I have a belief in, and I tend to buy it when there's no reason to buy it. When everybody doesn't want it, I think, well, there's something interesting. So I'm interested in home builders. I'm interested in the mining sector because I can see that they do have, once we get past this recession that's coming up, if it happens, if it does, it's probably for the majority of 2023. Once we get into 2024, you have a structural deficit in terms of the amount of mines and materials needed for just the EV part. And you also have a structural shortage of housing. And housing uses a lot of copper. EV cars use a lot of copper. So I have a long-term bullish view on that, but I don't know if we're going to have a soft landing or a hard landing. I really don't know what's going to happen. I do know that I want a position. So the positions that I have taken are what are called initial positions. If I want 5,000 shares of something, I'll grab 750 shares for now. Or maybe I'll sell puts to get my initial position. So if I'm interested in getting more pick, maybe I'll go out 2 months and I'll sell 33 puts and just hang out there. If I do buy shares, I know they're going to be under pressure for 2 to 3 quarters. That gives me great permission to sell calls. And selling calls allows me to generate revenue at a very low risk, because I already own the underlying. So by selling the calls on that, I'm now generating income. If I don't own the underlying, I can't generate that income without significant risk, because now you have naked calls, right? So the ownership of it has a dividend stream, and it allows you to begin to sell calls. So you generate an income stream from this over time. Hedge funds and institutions really don't play that way, simply because they have to beat a benchmark. So it's not enough to say, listen, we know that it has long-term prospects, but it's going to underperform for quite some time. We would rather be in something that will outperform our benchmark, and for hedge funds, they're looking for absolute return based on some information advantage. As a retail investor, you're not going to get access to the same people and the same resources as bigger money does. Ideas come to bigger money. You don't have to go looking for them. You're not going to have that advantage, which means you got to be strategic. You got to think about, well, how do I want to get into this market? How long do I want to stay in this market? How am I going to generate extra income in this market? And how am I going to get out? So I'm getting in and using the options to sell the top part of the distribution, which I don't think will happen. If it does get called away from me, well, I make money. If it doesn't get called away from me, well, I make money. See that outcome? Isn't that nice? Let's see, last one, crypto market. Currently there are rumors another exchange may have gone bankrupt, FTX. Well, it did sell itself because of liquidity concerns before this bad thing happened. Question I have is, given these current circumstances, why this market is still around and still has a huge market cap? You and me both. I just can't understand why there are billions of VC funding in this market. Never mind that retail investors. I wonder why institutional investors are still interested in this thing. Shouldn't these guys be more intelligent? Have we seen a situation like this before? Well, you can look at this in 2 ways. You can look at the investment as what you're investing in, in a fundamental sense. This is a crypto coin. Let's say somebody comes to you with this idea of a crypto coin, or an exchange for people to trade crypto coins on. When you're the exchange, you're just the casino, by the way. You're not the player. So you can look at it in that particular sense, or you can look at it from a higher level. And the best way to do that is through religion. I'm an atheist. That means I don't believe in any particular God. I'm not an anti-theist. An anti-theist is somebody who doesn't believe in God, but also doesn't want you believing in God. They try to convince you there is no God. I don't really care about that part of it. I think, does your belief give you power? If it does, all the power to you. If it doesn't, you'll stop believing. I don't need to convince you. If it gives you power, all the power to you, right? I don't believe in God. However, I do believe, especially in the U.S., in the southern U.S., that religion is a huge money-making business. That if there was a young up-and-coming evangelist that was growing their numbers on YouTube and looking to establish a big church of whatever somewhere, but needed seed money to get that done, I'd be an investor. Not because I believe in the fundamental value of God, but I believe that a lot of people believe in that, and this person's attracting a huge audience. And those people will spend money on what they believe in. I don't have to believe in it. I just have to believe that they believe in it. So if you look at it from that perspective, and someone's bringing you a coin, the question that you should ask is, will the market believe it? How many people will believe it? How many people will be drawn to this? It doesn't really matter if it has value to you. It only matters if it has value to other people, and you're making money off the belief that those people have, not on the product itself. In other words, the people are the product, not the coin. If you look at it that way, it kind of makes a little bit more sense. And you got to keep the religion going, though, right? Events like this, well, that doesn't keep the religion going. That's like somebody attempting to walk on water and realizing that nope, you can't walk on water, you sink. Well, if you're claiming to be the Messiah, that's really kind of a strike against you, isn't it? Okay, if using the poor man's covered call strategy, and upon expiration you are signed on your short calls, well, you would gain the difference between the strike prices, wouldn't you lose all the extrinsic value on your long in the money call? I think you mean time. So this is what it would look like is here we are today, t equals 0, is you would buy a call for a long period of time, let's say t, and then every so often you'd sell calls against your long call. So that's a covered call. So if this is called away from you, you can always exercise this and call it away from someone else to meet that call. But if you do, you're giving up the time value. Yes, you are, which is why you want to be careful about, if you're selling a call, you have to have a belief that the strike price you chose would not happen. So what is sometimes a common mistake to make is you're looking at a price chart, over time, and it's doing this, and you decide, okay, I'm going to buy a long-term call, and then I'm going to sell some calls. And you say, well, the price is here, so I'm going to sell a call here for this period of time over here. But what you're not paying attention to is the trend, right? You have to say, well, if I'm going to sell a call 30 days out, you have to project the trend 30 days out and say, well, if I sell this call, I'm really selling an at the money call. There's a high probability to be called from me. Is you got to go a little higher to avoid the trend. So if you do have an upward trending stock and you're selling calls, 30 days out, you must project the trend 30 days out to see where the stock would be. You can't just say, well, it's over here, I'm going to sell it an out of the money call, because that out of the money call may be an at the money or in the money call in 30 days if you extend the trend out. So, pay attention to that, because the call will be centered around the forward price. The forward price will look like this because it uses a risk-free rate as opposed to using the growth rate of the stock you have. But yeah, you would lose that, which means that you have to have some management of the call itself. You'd close the call out. You'd have to determine, should I close the call out or should I exercise the call? It depends on how far it goes. The further in the money it is, the less important the time value component will be. The time value amount shrinks and shrinks and shrinks the further it is in the money. Persons who currently want a job but not in the labor force, could they still be actively looking for jobs but simply just be underage or overage? Yeah, well, yeah, if you're under a certain age or over a certain age, that household survey doesn't apply to you. They don't even talk to you. But we do know there are people who are 67, 68, 69 who are still working. I remember, besides actively looking for jobs, one has to be in the age range to be counted in the labor force. In the household survey, yes. For the establishment survey, they just ask about a job without regard to, well, hang on a second, the person filling that job, are they within the age range? It's just, there is a job that exists, that's it. But for the households, it's like, are you between these ages? You're not? Thank you. Meanwhile, they may be looking for a job and they may get a job. So that is also a difference that you might find between the household survey and the establishment survey. If I'm holding the market, would it make sense to do covered calls at 16 delta, 30 to 45 days to expiration? I mean, even if premiums are low, I still get a bit of protection to the downside, right? Just covered calls, not naked calls. Well, yeah, you could sell covered calls if you don't believe that the market is going to go up. Let's say that you're going out 30 days and you're selling 16 delta calls. That means that there's a 16% probability that it would be called away from you based on, roughly speaking, a normal distribution of future returns. And if it doesn't get called away from you, you get the premium. When you say it gives you downside protection, you're right. It gives you a bit of downside protection to the extent of the premium that you paid. But if you sold a call and the market starts dropping and the sentiment is real, that there is some event why the market is dropping, I would immediately close this call and roll the call down. And if the market keeps dropping, close it and roll it down, close it and roll it down. Keep rolling down your calls to capture a rolling premium on the way down. It'll give you a lot more protection than waiting until the first one expires before you put the next one on. Okay, regarding the explanation on GDP and the future potential peak in equity markets, I understand the company values in the long run should trade for the discounted cash flow. Having a lower population would in theory reduce future cash flows. Why? And therefore reduce company valuations. Well, if I can see that this would flow from this statement, but this statement I've got a question mark around it. I'm not sure why we think it would reduce future cash flows. At the same time, when you say companies come and go from the index, and this should prevent a peak in equity markets, I don't quite get why. It should prevent a peak? Oh, I see. Okay. Yeah, okay. Right. I don't quite get why. Okay, I'll answer it all as one whole. I just want to get the whole question out of the way. The only way equity markets can grow is if the total market cap increases. If the top 500 changes often but total market cap does not increase, why wouldn't the total market cap increase? That would lead to a peak, or am I missing something? Also, when you mention a new definition of growth from GDP to GDP per capita, wouldn't that be useful only to compare economies based on company valuations since they trade off discounted cash flow? Well, I don't know if we're making any kind of connection or if I was making any kind of connection here. So let's say that there is a market of 100 people and there are 3 companies serving that particular market. And let's say that they have 40, 40, and 20, and the market drops to 90. And the stronger players go to 42, 42, and this one goes to 6. Eventually this company will disappear and these companies will have 45 and 45. This company will leave the S&P and a new company from somewhere else will come in, but these 2 companies are now stronger than they were before, even though you have a shrinking market. If you have a shrinking market, you're also going to have a shrinking number of businesses, which means you're going to have more concentration. Strength will win in those particular markets. So I'm not sure that we would say that future cash flows would be reduced because future cash flows have been increased for the survivors. The weaker companies have gone away. And if we're thinking about, well, in aggregate, about across all the businesses, that cash flows will decrease, okay, but the S&P 500 isn't the aggregate of all businesses. It is 500 businesses that have to meet a particular criteria to be in the index. If you have a concentration of power in fewer and fewer players with shrinking markets because the weaker ones disappear, the stronger ones continue on. Not only that, the prospects of a company are made up of both price times quantity. So we still have price that can also increase. So I don't know that we would have decreasing market caps or decreasing cash flows in the future from a sample that we take, in which inclusion in that sample must meet a certain criteria. And if you don't meet that criteria, you're excluded. Again, so these three were in, this one's now gone, there's two, there'll be another one replacing it that was stronger than the one that left. And if the market continues to shrink, let's say it goes to 80, eventually another one of these companies will disappear. So if the market drops to only 60 people, one of them will be left, which will have all the customers, and you'll have a monopoly. And it went from 40 to 45 to 60 while the other one failed. That is what happens in business. If you have a shrinking population, you'll also have a shrinking number of businesses. As far as GDP per capita, when I use that, it's if you have a population that starts to shrink, you're going to have decreasing GDP, but you could still have increasing living standards for everybody else left in the country. That GDP is not decreasing as fast as the population is decreasing, in which case you have growth. You have positive GDP growth per capita. So a new definition for growth when you have a stabilized or shrinking population would then have to redefine what a recession looks like. I don't know that I was making a connection between that measure and company valuations. Is the VIX index only affected by the demand for puts? No, it's not. Let's just draw a line here, and let's say this is the price of the index. That is called at the money. And the VIX uses at the money and out of the money options. Well, if you're going this way, out of the money options are calls. If you're going this way, out of the money options are puts. At this particular strike price, a put and a call will have the same IV. IV for the put will equal the IV for the call at this strike price. At each particular strike price, this is true. It has to be true because of put-call parity. And if put-call parity did not hold, arbitrage would step in and make it so. So because it sets up an arbitrage opportunity, you end up in a situation that because of arbitrage, the implied volatility of the put must equal the implied volatility of the call. So you could, in essence, just use the implied volatility of the put. Why don't we do that? It's because we believe that the implied volatility of the call is the correct one, and arbitrage will push the put price into alignment as opposed to the other way around, because the call is all time value. There is no intrinsic value in there. Once you get intrinsic value in there, you get less and less time value, in which case the implied volatility may not be measuring the volatility in the price correctly, because much of the price for an in-the-money put is a fixed non-volatile price called intrinsic value. So that's why you would use the out of the money, you'd use the call. It would be a pure measure of implied volatility. Now, if you go a certain distance from at the money, let's say you go $10 out to a call and you go $10 out to a put, they will not have the same implied volatility. Only at the same strike will they have the same implied volatility. Generally, for an index, you have skew that is downward sloping. In good times, you do not have call buying to the same extent that you have put buying in bad times. So puts, the purchasing of the puts is generally the driving force behind a rising VIX, is generally the force, and the less demand, the closing of puts and the dropping of the demand for puts is generally the driving force of the drop in demand, the drop in the level of the VIX itself. In practice, aren't most of these statistics, probability and quantitative methods readings from the CFA curriculum useless? Let's not use the word useless. To a certain extent. Well, you've got some words in here, and when we're constructing sentences, let me see if I can help you construct better sentences. You have most, which is not all, and you have a certain, which is not always, but you have useless, which is an absolute. So you have two relatives with an absolute. You want to try to construct your sentences so that the thoughts are the same. In practice, You could say most, somewhat, you can, and then useless, you would have put somewhat in there so that they all matched, right? Just trying to help you do better on your GMATs there. To a certain extent for private equity professionals. If not, could you provide a broad overview of the skills that can be applied in PE? So we learn things for two reasons. There is the production model and there is the consumption model. The production model says we're going to learn this stuff because we want to produce output based on that. The consumption model says we learn this stuff because we're going to have to read somebody else's output that is based on that. So as far as PE is concerned, as long as you're never going to read an analyst report on a particular industry, as long as you're never going to read academic research on the drivers of value, as long as you're never going to look at a return series that is smooth and unsmooth and wonder, well, which volatility should I use, the smooth or unsmooth? As long as you're never going to do that, then yeah, you probably don't need it. But the knowledge of the statistics at level 1 and level 2, which, by the way, if you compare it with the university curriculum, is rather juvenile. The university curriculum is a lot more rigorous in its statistics. But if you just take the it is really a big introduction. Level 1, level 2 really introduces you to this stuff. If you take that in terms of learning it so that you become a better consumer of somebody else's output, then no, it's not useless. It's actually quite useful. You can also argue that the FRA at level 1 and level 2, financial reporting and analysis at level 1 and level 2, are rather useless as well, because a PE manager or VC manager is never going to produce the income statements and balance sheets. Why should I know this stuff? Well, are you going to read income statements and balance sheets? And if you are, you need to be a good consumer of what you're reading, which means you have to have an understanding of how they were produced. You don't necessarily have to produce them, but once produced, you must now consume them. You must be a reader of it. So I'm going to go ahead and say no. Okay, it might be a naive question, but at 4403 you describe how it is zero-cost debt that the Fed takes from the Treasury. Why would they do that? Is this what the Fed does when they print money? Yeah, it is a way of printing money. So you have the Fed over here and you have the Treasury over here. Treasury issues debt. The Fed says, oh, we'll pay for that debt, and then the Treasury spends money in the open market. The Treasury will pay the Fed a coupon. At the end of the year, the Fed returns the coupon to the Treasury. And that cost $0. And then when the Treasury gets money back in, it gives it to the Fed returns the bond, and it's gone. So it introduces money into the economy, it extracts money out of the economy, and retires the bond. In the meantime, it's zero cost. It's like lending yourself $12 and charging 2% interest on it for a week. You got to pay yourself back that 2% interest, but it's all yours anyways, in which case it doesn't cost you anything. You can charge yourself 50% interest, and your right pocket will be making 50%. Your left pocket will be losing that interest, but in the end, it doesn't cost you anything, right? Next one, do you have an opinion on CAD, Canadian hedged stocks or ETFs? And would you recommend buying a CAD hedged stock right now? Wealthsimple provides CAD hedged products over buying in U.S., especially since Wealthsimple charges a fee for U.S. stock and ETF purchases. Now, from my understanding, it would be the same as being short U.S., which might not be the worst idea given the run it's had. Well, yeah, at that point, you're hedging out the currency, and you're only going to get the return that the U.S. stock actually has for you. So, sure, you can do that. And if they're doing it for you, well, great. It takes that out of the picture, right? I would also argue U.S. CAD looks bearish from a technical standpoint. Yeah, well, yeah. That's short term, right? All technical levels are short term in nature, meaning that lacking any other guidance, that would be the entry and exit points that I can find. They're all short term. If you're holding a stock to a technical point, then maybe you don't need to be hedged. You just play what's behind it. If you're looking at hedging it, who cares what the level is? Who cares where any level happens to be? You're really only interested in the return on the US stock itself, translated into the Canadian at whatever exchange rate you hedged out at. But yeah, if you don't know how to hedge yourself, then fine. If you are buying U.S. stocks, you do risk the return that you get being taken away by the change in the currency, unless you buy that stock using options, using a synthetic position, which gives you zero exposure to U.S. dollars other than just the capital gain that you're making. But the base price of it, if you're buying a $100 stock, you remove the fact that there was $100 that could change in value at that point. Only the change in the value would change with the exchange rate. Okay, in the context of the UK, which one do you choose in terms of keeping R greater than G, tax cuts or tax increases? I think we want R less than G, right? R is your cost, your weighted average cost of debt. G is the growth rate in your tax revenues. And you'd like this relationship over here. So the increase in your tax revenues, if you held tax, your tax revenue as a percent of GDP constant, inflation, your tax, the amount of taxes you collect should increase at the rate of inflation, which we usually signify as just pi. And R is the weighted average cost of the incremental debt that you're issuing. And you'd like that to be lower than G, so that if interest rates go up because of inflation, inflation is pushing the tax revenue up by more than the cost on the debt. That is what you want to keep. If you have tax cuts, you'll actually lower the G. Even if you have inflation, you'll lower the G, but you might encourage more inflation because of more spending. And if you encourage more inflation, then your R would go up. Now you're going in the wrong direction. The UK declared a whole bunch of tax cuts, lowering R but increasing G. Other way around. Let's see, now UK is introducing tax increases, which will likely increase R. Well, other way around. I think you might be getting confused between R and G. If you have tax increases, if we assume that we have a constant tax revenue as a percent of GDP and we have inflation, then G will increase at the rate of inflation. But if you have inflation and you have tax increases at the same time, G will increase at the rate of inflation plus the change in the tax rate, the blended tax rate as a percentage of GDP, which might be 1 or 2 percentage points, right? But that would make the fiscal position of the country a little bit more sound, so that the bond market would not demand a significantly higher premium, so it would cap rates to the downside. This is a time where a tax increase, or at worst no tax decrease, would make sense. So when the previous prime minister cut taxes, it was met with, well, you saw what happened. And the reason was simple, is that, yeah, okay, we can get behind tax cuts, but now is not the time for tax cuts. There's a time and a place. Now is not the time for tax cuts. And even somebody who might have been in the highest tax bracket probably would have said the same thing, that, look, man, now's not the time for this, because all you're doing is ruining the very economy I need to continue making the money I need by doing this. There's a time and place for it. That was the wrong time for it. Okay, where can I locate buy-sell imbalances on the open close from my broker? Usually in your news feed, it'll just scroll by. At least that's what I see on mine. Can you explain why quantitative tightening works? Yeah, so here's a yield curve. Let's say we'll just draw a simple upward sloping yield curve. And I'm going to, quantitative tightening means I'm going to sell my bonds. If I sell bonds, what I'm going to do, let's say I have mostly 10s, 20s, and 30s. What's going to happen is this kind of thing is going to happen. Well, that is higher yields, because there's your yield over here, right? And if we look at mortgage-backed securities as tracking the 10-year yield, the higher the 10-year yield goes, the lower the price of MBS, because the higher the yield would go, the higher mortgage rates would go at that point. That's tightening in the economy because you're taking credit out of the economy by making it more expensive. How to select good active managers for the next decade when most of them underperformed their benchmarks in the last one. Yeah, well, that's the job. It would be the same thing as saying how to select stocks that will outperform the benchmark, the S&P going forward. Well, that's your job. Track record will do. The nature of the market. Some markets, especially in the large cap space, have mean reverting performance, which means managers that outperform over a number of years tend to underperform over the next few years, but over the long term they tend to perform in line, if not slightly below. Some markets don't have mean reverting performance, which means outperformers continue to outperform. But there you have to go into probably international markets, emerging markets, small cap, aggressive growth, tech, things like that. So I don't know that there is a couple of rules that I could write down. If there was, there'd be an algorithm for it and we wouldn't be needed. Let's see, going back to when you discussed XLY, XLP, I was wondering what your thoughts on RCD, RHS, same thing, just equal weight. You'll find the same relationship, just lower volatility because they won't be skewed by the bigger players, especially in XLY. XLY, the top two, I think, make up a significant amount of XLY, which, what were they now in XLY? It was Amazon and Tesla. Well, Amazon is being crippled. I don't know if Amazon makes up that much anymore, and Tesla is, on a pre-split basis, is under 600, 570, heading down. I saw a price target for 130 on it, which would put it at 390 on a pre-split basis. They're 190 as of close yesterday. So it would just take out the volatility of the large components, but you should find the same relationship. Is that in a slowdown, discretionary would have dropped by more than staples. So you'd see the same relationship, just with lower volatility. What exactly a dropping balance gradually in the Fed balance sheet amount would impact the equity in the bond market in the short term, midterm, when the figure gets closer to 7 handle or even lower figure? I don't know. Nobody really knows. That's the unknown part of this. And there doesn't seem to be a healthy enough level of skepticism in the market or pessimism in the market as to what it does mean. And I don't even think the market's really paying much attention to it because given the size of the balance sheet, how much is running off per month is so small per month, it's incrementally small enough that the market can adjust to those things very quickly. So you can get to new equilibriums rather quickly. So you have a balance sheet that's run up like this. If you try to do this to it, that's a lot of market dislocation. Trying to get equilibrium levels would require a lot of disruption before you get to some more stable level where the market can find an equilibrium. But if you get to this level and you're just going to bleed it off slowly over time, and you have, it'll take a year. This is 8 trillion. It'll take a year just to get down to 7 and another year to get down to 6. So basically it would take 8 years to get this to 0. That is a slow enough pace that the market can find a new equilibrium in terms of liquidity in that market rather quickly because it's not this huge shock. And in fact, it's such a small little trickle that other than real market participants like dealers that have to make a market in these things being aware of the effect on the bid-ask, they'll widen their bid-ask spread, which is what gives the appearance of reduced liquidity. Other than that, it's small enough that it's not going to be noticed. That if they didn't tell anyone and this were all behind a curtain, probably the market wouldn't even know what's going on. So I don't know if there's some level that you get to where it's like, uh-oh, this is a problem now. I don't know. Well, I don't know. I don't know that anybody knows. I don't know that there is a level, and if there is a level, nobody really knows where it is. Is the VIX available already in pre-market with the option market still closed? Well, the VIX is an index. You can't do anything with the index itself. Also, the index is delayed. If you are not paying for the data, the index is delayed by an hour. So if you're just going to use the free data that you get in whatever package you have, so you can get VIX with Interactive Brokers. It'll be delayed an hour unless you specifically subscribe to the VIX data. Isn't that supposed to be a read at ATM implied vol 30-day? Yes, it is. Referencing to your statement that you will probably buy in the pre-market if the VIX goes up and DXY does the same. So they'll probably it does have price movement in pre-market because there are futures that trade on the index itself. I'm not an expert on exactly how the pricing is arrived at outside of regular hours, but I do see price movement in the VIX. It could be model driven until the market opens and we get a read on pricing. I don't know. Referencing your statement that you will probably buy in pre-market if the VIX goes up and DXY does the same. Well, these are indexes. The DXY we don't have to worry about. It's a basket of currencies. I get your point over here, but you know it is model driven. I'm looking at the VIX this morning, and I can see that futures are, you know, they're down this morning. It's not quite pre-market yet, and I can see the VIX is elevated. I can also see the options, my options price changing in my portfolio because Interactive Brokers gives me model-driven pricing. So it just could be, I don't know that Interactive Brokers is giving me the model-driven pricing or the exchange is giving the model-driven pricing. A lot of that stuff, I don't know the background to all of that. Maybe somebody listening does know how that is done. I imagine they might be using, because it is an index, maybe they're using the nearest dated futures contracts outside of regular hours and doing something there and just using model-driven pricing to determine what it would be until they start getting their pricing series. I don't know. Let's see. Will we not get to the point where central banks are losing money from interest payments? No, they wouldn't lose money from interest payments. Central banks hold bonds. They receive the interest payments. They don't make the interest payments. So every country has a treasury and a central bank. The treasury issues bonds and pays interests, right? So the treasury has to pay interest, but the treasury gets tax revenue. So all the government's money goes to the treasury and the treasury pays the bills. The central bank holds bonds, so if the treasury issues bonds and some of it goes to the central bank, the treasury pays coupon interest to the central bank. The central bank doesn't pay the interest. I was doing a presentation yesterday, made a statement about the range of unemployment where the Fed might need to consider reducing the throttle on rate increases to be somewhere around 4 to 4.2. Do you think that is accurate? Well, the word accurate is the wrong word to use when we're talking about something like this. You're not going to be accurate, but in the range, in the neighborhood would be a better word to use. If not, where do you see the dual mandate Fed taking notice of unemployment and skewing away from maximum employment? And will the labor participation rate factor in? Well, I think for something like this, I don't know that there is a level of unemployment that they would be concerned about. As long as the rest of the economy was strong, I think if it got to 4.2% and you still had wage inflation of 5-6% and you had core CPI running around 4%, I don't think they would take notice at all. It would be, curious at that point. I think you'd be on hold at that point. It would be curious that, well, we've had a significant increase in unemployment, but we haven't seen it affect core, which would be more on the concerning curious side than the interesting curious side. And if inflation got higher and they saw that, well, wage inflation is coming down, inflation is coming down, good, we're on the right track. But I don't know that they would then run to the other part of their mandate if the first part, if inflation was still hot. There would have to be, I think, some significant drop in the employment situation for them to abandon the inflation fight, if the inflation fight still needed to be fought. But if inflation is coming down and unemployment is coming up, if they see that inflation is coming down, then they might have a lower level of unemployment at which they would say, okay, maybe we should do something about this. Okay, question regarding job opening numbers. Why hasn't that come down given so many tech companies have hiring freeze or cutting jobs in some instance? Meta just announced large job cuts, 13,000. Stripe, Apple, Amazon with hiring freezes. Should we see job openings to drop significantly in coming months? Well, perhaps. You might even see them increase because for the longest time, tech jobs or tech workers were just impossible to find. Good ones were impossible to find. So if you take our company, for example, we searched almost 2 years. We had an ongoing search, and we were willing to hire any good person that came along. Hiring somebody who doesn't have experience is actually just a drain on resources because we don't have the time to train them, because that would take people away from jobs that needed to be done. So we had to hire somebody hitting the ground running. Eventually we gave up. Well, with everybody with freezes and especially a whole bunch of tech companies laying off, maybe now might be a good time to post a job opening again, right? They're releasing workers. There's a whole bunch of frustrated companies who just said, well, what's the point of looking? We're never going to find anyone. May now decide to repost saying, if these people are leaving, we'll take them. So they may actually see, or we may actually see an increase in job openings being posted because of this. Do you expect the CAD to slide even lower? With BOC going with a stride of 50. Well, I don't know if they're going to stride at 50, but they dropped to 50. They may go with a stride of 25 and then end. US with a stride of 75. Further, looks like we continue to be in a downtrend of commodity cycle, except crude, which is sideways to up. I'm not sure what is a good time to get back into CAD. Yeah, that's a good question. It's seeing strength right now. I think if you had a poll of economists of which economy would see a recession first, Canada or US, I think it would be Canada hands down. So that we should see some weakening. Plus, if we do have a global recession, money will flow to safe havens, which is the US, so the Canadian would weaken even more. A scenario for a bullish Canadian is a soft landing with growth and strong commodity prices, with lowering inflation or much lower reads of inflation in the US, where we think the US will stop. Then there'd be no reason to be in the DXY. But as long as there's a reason to be in the US dollar, yeah, the CAD is going to be weak. And if we continue on the trajectory we're on right now, which is kind of like in the late slowdown period, contraction in the road up ahead as far as the business cycle, I don't really see a soft landing. I see a recession, a contraction, but I don't have any visibility on how deep or how long or how shallow that recession will be, because it will depend on the rest of the world. So I don't think I would be bullish on the Canadian. I think if you look at the March futures, they're sitting at about 74.6 to 74.7. I think if I saw 75, I think I would probably short the March futures on the CAD. Let's see, can you explain what's constant 30-day option means for the VIX? Yeah, that means that here's a timeline, and we'll break it down by seconds, right? That means as 1 second goes by, we add 1 second here, so that we look at the implied volatility 30 days out to the second. As the next second goes by, you add 1 more second. The next second goes by, you add 1 more second. So at any given time, it is an exact 30-day implied volatility to the second. Why do they choose the next 2-month options price? Because you need 30 days, right? So let's say that you have an options expiration over here that's 14 days away. Well, you only need 16 days to make 30 days. So that would be the next. If you had this one, the next one, and the next one, well, now you're over 30 days. So if you had 12 days left, well, you only need 18 days here, which still only is the first and the second. Okay, I would like to know more your thoughts on China news. I think the market is pricing in positive impact from the news. To me, I'm wondering what specifically are the positive impact. My thinking is if, well, good. Capital letters and in quotes. It's only 2 letters long, but it's the biggest word in the English language, if. If China opens, will that help to control inflation? Well, we're seeing that Apple and some other companies that have suppliers in China are saying that they simply can't get what they need, and their output is lower than it needs to be because they simply can't get the parts. And if they can't get what they need to increase the supply to the market, that would support prices. So at the margin, I would say it probably would help to control inflation at the consumer level. We can make an argument for that. I don't know if we can make the argument that it would control inflation at the producer level. In other words, the raw material inputs, there might be more demand for that. Also, I know you shared the news showing the Chinese government still remaining on the zero COVID policy. However, I pay more attention to what they do rather than what they say. Always, always. I agree with that. Always pay attention to what people do, not what they say. I also watched other news from Chinese local government that they are lifting the restriction. Another example is people in China not required for COVID tests anymore for domestic travel. Big improvement compared to a few minutes ago. What do you think if China is opening again? How should we position for this trend? Well, here's the take. I don't really know what the upside would look like, but opening up would certainly not have downside. It wouldn't certainly make things worse in the world, right? It's not as if, well, okay, they're going to start consuming again, they're going to start producing again, demand from China will come back. I don't know that that would make growth worse in the world. I don't know that that would contribute more towards the probability of a recession, but I don't know that it would help. I don't know what upside impact it would have. While it would support economic activity, would it also prolong inflation? I don't know. And living in the Western world over here, that if what we need is a recession to fix inflation, better they have the recession than we. Right? So if they have a major recession and prices drop considerably because of that, and we get inflation under control because one country falls on their sword for the rest of the world, better it be them than us, right? As far as the upside, I don't know, but as far as the downside in terms of growth, I think it would just be better for economic growth. Just don't know about inflation. So it's one of those that, you know, this is what makes a market, right? You have your particular views, and there are some people who will have a better visibility on this, and they will make certain types of trades. I don't have the best visibility on this, so I'm not going to include that analysis into what I do because I don't know. But I just know that it can't be worse. It can't make things worse. It can't accelerate the recession, so that's a good thing. If I felt that it was going to be a net positive, I would be long the Aussie and the Kiwi dollars. That's a safe place to be, being long Aussie and Kiwi dollars. I'd probably be long the miners, which I already have some exposure to Rio, to BHP, because they would benefit from that. I don't know any Chinese names that I would be interested in. That would be about it. I'd be, those are sort of like not direct investments on the China trade, but they're more peripheral. Is by being long the currencies of their biggest trading partners and of their larger imports. Energy, I think you'd have to go long energy on that one as well. In reference to the debt section, isn't it also true that the interest-bearing debt that the Fed will need to pay out, that the Treasury will need to pay out, should be reduced by the Fed amount? Yep, and the federal trust funds and other government accounts, that is true. That would leave the Fed debt held by private, according to 18.17, which is even lower than the 25 I got to. Good. You mentioned this, you just did. Yep, that's true. All this would do would make the case, would make my argument even more powerful. That the incremental increase in the debt is, absorbed more than enough by the increase in the tax base just due to inflation. So it only makes that case even more, which means we don't really have to concern ourselves with the level of debt at this point. The only time we have to concern ourselves is when the percent of GDP, that tax revenue as a percent of GDP drops, because I did that analysis assuming 17.8. And if it drops down to 15 or 14, because in a recession, your tax base gets lowered, but also you lose capital gains, right? You're going to have lower capital gains tax and lower corporate incomes. I am subscribed to your options course, and I'm wondering, what are the main risks with early exercise, and what if the main risk metrics are sufficient to leave me out of trouble? Well, the main risk with early exercise, if you're, the only time you get exercise is if you're short. If you're short a put, you got to buy it. So you'll need money to buy it. If you're short a call, well, you have to have the shares to deliver. If you don't, you'll end up with a short position. So you got to make sure that with a short position, it's not a big deal because you get money. You'll still have a loss on the position, but you had a loss on the option, so it's not as if you're going to suddenly have a bigger loss. But you'll have a short position. You got to be careful about that because there may be borrowing costs with maintaining that short position. There may be dividends on that short position that if you keep that short position open, you'd continually have to pay those dividends. So if you feel that you are in risk of early exercise because your short positions are in the money for somebody else, you might want to consider rolling them at that point. Or if you're comfortable with them being called or being exercised, then you'd continue to hold them. But no, the DDB over NAV, margin over NAV, not really, unless you look at if you look at it at the position level. So you can look at it at a portfolio level, which is the way I look at it, and I manage that number from a portfolio level. But at the position level, I am aware of what's in the money and what's not in the money. I look at how much time value is left. Versus for puts, you got to look at the time value that's left versus the interest rate, because if I can put my shares to you, I get money today that I'll earn a cash rate on till expiration. If the cash rate that I earn on the strike price to expiration is more than the time value, I'll put my shares to you. For calls, since I don't have to part with money, I don't really care to exercise a call till the last minute. Because if I have to part with money, I lose the cash rate, but my option still has the intrinsic value, so I'll wait till the last minute unless the dividend being received is going to be greater than the time value of the money that's left. Then I'll exercise the call. So if you're aware of those two things, you'll be aware of when you're in a high probability call situation or a high probability exercise situation, and then roll your options. Second, would using 0.2 and 0.1 delta credit spreads to increase or decrease DDB be a good and safe strategy in the long term? Now, the premise that my portfolio theta NAV will not be greater than 1. Yeah, you can use spreads to change the dollar delta beta depending if you're having positive or negative exposure to them. It will, at the margin, reduce that, yes, or increase it. 2 questions. Clarify the relationship between Treasury and Fed for the debt, even if that money is 0% interest. Well, when I say it's 0% interest, it's net 0%. It's not 0% interest. There's still interest on it. But the Treasury is paying the Fed, which the Fed then returns to the Treasury. So as far as the Treasury is concerned, it's zero cost. How did the Treasury get the money from an investor accepting zero? Well, because the investor is the Fed, right? So you have the Fed, which is a government entity, and you have the Treasury, which is a government entity. The Treasury issues bonds. The Fed says, I'll take some of that, and in the Treasury account, it will move over some decimal places, so suddenly you have more money. I'll stick a 1 in front of that, and we'll move over a few more decimal places. There you go, and the Treasury will then pay bills or spend that money based on what Congress has said that Treasury should be paying for. It is the Fed that's holding the debt. The Treasury pays a coupon to the Fed. At the end of the year, the Fed returns the coupon to the Treasury. So it's zero cost debt. As the Treasury brings in tax revenue, it then gives it back to the Fed. The Fed then gives back the bond to the Treasury, and that money gets canceled. So there is no investor here. You have a price-insensitive investor, which is the Fed, which is a government organization, same as the Treasury. Do you know how gigs are counted in the jobs report? This will be in the household survey. Because gigs are contract-based. I'm assuming they're contract-based because if they're not contract-based, then that just means you have multiple part-time jobs. So when I hear somebody say, I've got to run to my next gig, I think, well, you're an Uber driver or something like that, but it's a contract position you have. not a job. If it was a job, that's not a gig, it's a part-time job, right? So because they're contract, there is no establishment saying we have a job. So you would never see it in the establishment survey, you'd see it in the household survey. For example, everyone who is a YouTuber, influencer, streamer, or even Uber drivers, yeah, they on the household survey, they would either say, I'm not employed and I'm not looking, which means they're not even in the workforce, or are you employed? Yes, I am, by contract or whatever the case is. They would fall under self-employed. If they are not counted, I'm thinking one of them could be part of want a job but not applying. Not really. I think if they were earning an income doing this kind of thing, that they would either be self-employed or just simply say, answer, I'm not looking for a job. Or they could be doing this stuff. They could have a few gigs for lack of a job, and they could say, you know, I am looking for a job. As soon as they say they're looking for a job, if they have looked for a job in the last 4 weeks, then they're in the labor force. If they're looking for a job but just haven't looked in the last 4 weeks, they're not in the labor force. Since their gigs pay them enough for now, and if that is true, if their gigs pay them enough for now, then, you know, it depends on how they answer, right? So if somebody's making enough money doing gigs, they would say, no, I'm not looking for a job, I'm employed. They would be counted as self-employed. Well, let me back that up to what I said. It depends on how they answer the question, because if you ask someone, they could answer the question of, I'm self-employed, or they could just say, no, not looking for anything. Well, you never really know, so you have to just take their word for it, right? Is there a benefit in pursuing the charter just for the knowledge it provides? If I wanted to work in a more finance adjacent field such as planning, strategy, accounting, investor relations, or even education, is it worthwhile to become a charter holder? So that's a good question. Pursuing the knowledge, I think, has value, but do you need the designation? Now, there's one line of thinking that says, if you're going to go through it anyways, why not get the designation? There you will push yourself harder when you have the reality of a test in front of you. You will learn it more because now you have some downside. When you're just learning for yourself, when you hit something that's frustrating, you tend to just say, okay, and you push past it because there's no cost to not getting it. But when you're writing an exam, there is a cost. You know, the charter does cost money to get. Is it worth having it? Let me sort of answer that with an analogy. Police officers it's quite common for police officers to take fight training. So if you go to a martial arts class, it is not uncommon to find quite a few of the students in there are police officers. But there's also a dentist in there. Dentist, what does a dentist need a black belt for? Right? So sure, the dentist could probably learn how to fight. There's lots of good YouTube videos. Lots of good YouTube videos, by the way, that show you technique. Like if you want to learn boxing, go to YouTube. There's some good videos out there that if you got the right equipment and you followed the technique, you could do it. So why couldn't you just do that on your own, right? Well, if you do it on your own, you never get the award. So you'll never get that status of I am a registered black belt. I do have this given to me by somebody who is recognized as being a sensei or an instructor. So there is some legitimacy to having it given to you in a dojo rather than having it learning the knowledge in your basement. But what does a dentist need a black belt for? You know, so you could sort of say the same thing about the charter as well. I'm going to go through and get the knowledge for the charter. But when it's all over, let's say that I really learned it. When it's all over, says who? I have no proof that I really learned it. So when you pay CFAI fees, when you pay your instructor fees, when you pay any university fees, you're not paying for the knowledge and the education because much of that is available from other sources. You're paying for the credential. You're paying a university to credential you after to say, we attest that this person knows what they're supposed to know. And that's it. So, you know, it's your call. you know, where I'd say the earlier you are in life, the more it would matter. The later you are in life, the less it would matter. The more you do it for your own knowledge, because at that point, you've done what you've had to do. In other words, you've opened the doors you've had to open, and your experience will continue to open the doors. But early in life, it's kind of nice to have an outside body say, we have given this person this level of knowledge. We acknowledge it with this designation. So there's proof to the market. When managing your own portfolio, is there an amount of DDB which you consider underexposed to systematic movement? You know, it really depends on what's going on, and that comes with experience. Is there are times where you have to just get a feel for the market. And when you are with the market long enough, you can get a feel for the flow during the day that, you know, there's been some news overnight. You're in the market that day. You're watching the prices, and it just doesn't feel right. There's something that's off. It just, you don't know what it is, but you feel that the market's holding back on something, or they're too excited about something that really was nothing. It's just a feel where you would lean in or lean out. Now, here is a business cycle. Just, you know, exaggerated business cycle. This and this are the most troubling times. This is fairly easy, and this is fairly easy. Bull markets are easy. Bull markets are easy. Lean in. If you're in a confirmed bull market and it's an expansion and the economic data is just getting better, lean in. Don't have any short positions. Lean in heavily. And when you're in a contraction, it's very clear that you're in a contraction. Lean into that as well. It's here where you start getting all this volatility, and you'll sell off, and then, oh no, oh, that was a mistake. No, it was the right move. Oh, it was a mistake. And same down here, you get, okay, we're finally in a bull market. No, we're not. Oh, we're finally in a bull market. No, we're not. These two, the turning points, are where money is preserved. You know, not so much made or lost, but preserved. And this is where your money is really made. And on your short position, you can make money there. But most people make money here. Then they start losing it here with all of this volatility. They get knocked in, knocked out. They'll lose down here with hope, and then they'll get knocked in, knocked out. And then they, you know, they only make money during one phase of the business cycle. So you have to read the market you're in. What makes this market where we're in right now seem like it's a lot of work is because it is. Markets like this, where you're in either a slowdown or the end of a contraction, these turning points are hard to navigate because you have to try to position yourself for the next phase. Well, what is the next phase? You know, is it going to be the contraction, or are we going to have a soft landing and up we go? When we see a recovery, is it going to be a recovery, or is it we going to continue on down? Last one here. I wanted to ask how you navigate the current market in terms of the business cycle. Oh, I think I just answered that. With the economy slowing down, it seems to me that moving into consumer staples is the best idea. However, how would you account for the significant sell-off that occurred in 2022 already? Well, when we say that consumer staples is better in a slowdown or a contraction, we don't mean that it makes money. We mean that it will outperform all the other sectors. So if the market is down 25%, I would look at consumer discretionary and I'd expect it to see it down more, and I'd look at consumer staples and expect to see it not down as much. Maybe it's only down 10% or 12%, but down it will be. In a slowdown, in the early part, when there's rotation out of consumer discretionary into consumer staples will hold its own, even continue rising, but at some point it will turn down with the market. It's only that it will outperform the market. So at the end of the year, if the market's down 25%, you're all in consumer staples, you're down 10%, but you're still down. Let's see, how do you account for the wildcard variables like inflation that sets a trend in the market that at first glance it may seem that it is deviating from its traditional pattern of looking ahead of the business cycle? I don't know what that means. Sets a trend in the market. First glance it may seem that it is deviating from its traditional pattern of looking. Don't know what that means. We'll just cross that out. I don't know what you're trying to say there. If I were to interpret it by book, I would think that the market still has room to go down since we haven't even started consistently seeing negative economic data. Yeah, if you believe that we're in a slowdown and you buy into the hard landing, off we go. But if you buy into the soft landing, we've had a growth slowdown. What if we do this, right? This is what some people are still betting on, is that there is a pathway to a soft landing, but Powell is saying that that pathway is narrowed significantly. In other words, you're probably right that we're looking at a contraction. Let's see, maybe I'm answering my own question, but it may also be that the market is in a holding pattern to see which loses first, inflation or the economy. Yeah, I think you probably have, two camps of investors. One of them saying soft landing, the other one saying hard landing, but nobody has any clear evidence on what it's going to be yet. So that, neither one camp has migrated to the other one yet. If the hard landing migrates to the soft landing, up we go. If soft landing camp migrates to the hard landing, down we go. And I think you're right, is that we are so data dependent right now. It's data point to data point to data point. Right now, we're waiting for the CPI on Thursday morning. That, what position do you take in front of that? Who knows, right? Because we don't have any other data that really matters at this point. So it's not as if we have a mosaic of data that we can put together and say, okay, well, here, the preponderance of the evidence says this. It is one data point. Everything in this market seems to be a binary event. That's hard to play. There was a lot of discussion about Fed pivot, and I said we should get rid of that word, and market rally it may cause. But if we look at three previous pivots, we can see that in all three cases, the market fell significantly within a year. So why the pivot should push the market higher rather than switch to waiting for recession mode. Okay, not a pivot. I don't know what you mean by 2019. So in 2000, rates were going up because of inflation, and then the economy crashed, or a recession. The stock market crashed. It was a recession, so the Fed lowered rates in response. In 2007, rates were going up. Fed was raising rates. It got to 5.25, held there. Then you had the market fall apart because of the credit crisis, and the Fed lowered rates in response. A pivot is when rates are going up and the market doesn't fall apart. There is no recession, and the Fed just lowers rates anyways. That's a pivot, where you're going up and you say, you know what, never mind, let's go the other way. And this would be in response to nothing. That's a pivot. This had a response. This had a response. Maybe you mean 2020. I don't know. But when you're doing it in response, that means the downtrend in the economy is already leading market results, or market pricing is responding to the economy. The Fed rate being lowered is meant to, make it less worse. But worse it's going to be. So in this one here, a Fed pivot means that, in December, the Fed would say, you know what, we're just going to turn around and go the other way. We're not going to wait for a recession. We're not going to worry about fixing anything. We're just going to go the other way because the stock market would like it. And it's true, the stock market would like that if the Fed can lower rates and help avoid a recession happening altogether, and then we just live with inflation. But lowering rates in response to the beginning of the recession is not a pivot, it's monetary policy. That's all. I was wondering what % of your portfolio you use for your active trading option strategies versus what % you have long-term holds. That depends. In a bull market, if we have a confirmed bull market, 100% would be long-term holds, almost 100%. I'd still have some options work in there, but it'd be more about selling puts on stocks that I want. Selling out of the money calls on stocks that aren't rising as fast as I would like to see them rise. But for the most part, it would be buy and hold, because there's, in any given year, there's only about 20 days in the year where the market really goes up. The rest of the time it kind of goes up a little, gives a little back, goes up a little, that kind of thing. But if you look at all the big moves in the day where the majority of the move of any stock comes from, you can usually bring it down to about 20 days in the year. When do those 20 days happen? Who knows? So long-term investing, getting those kind of gains, is about time in the market, not timing the market. But at turning points, especially where we are right now, you got to get a lot more active. So there you have fewer positions that make up your core and more positions that make up, sort of active positions. It depends. What are your current prospects regarding agency? They're good. Near term, yeah. Let me write that out. Meh. Near term, meh. Long term, good. Long term, very good actually. Usually with companies that have primarily financial assets, whenever they suffer fair market value write-downs, it's usually followed by years where they followed by fair market value write-ups. Agency's last earnings report was good. You can't look at net income. That, for a company like Agency, for a mortgage REIT, net income is meaningless. You can't look at that thing. You got to look at a different metric. By the way, if you have the applied series, the bottom-up folder will appear tomorrow with a video in there, and it is Agency. It is 27, 28 screens long. There is, I think, about 9 screens of education that you're going to need before you can even understand what Agency does. I describe everything you'll see in Agency statements. And then we go through Agency's results. And for a company like Agency, any financial-based company, history is meaningless. All that really matters is where that company is and what your outlook is for the market, for the mortgage market and for the housing market and for rates. What it did 2 years. So you don't have to look at its ratios over 2-3 years. It's meaningless. We just have to look at how it makes money and how it manages the risk of making money, which is what I did. So that one will be up tomorrow. I just got to finish narrating it. It's long. Be prepared that it is long, because by the time you're done, you should understand everything that you read if you pick up Agency statements and read it, and you should understand how it makes money and how we're measuring the success of it and how we would think about the value of this company on a going forward basis. But midterm, I have that midterm is 2 to 3 quarters. I don't know. Depends on how the market prices certain things in. I know you've been a buyer when it was below 8, and I still will be a buyer below 8. I think a bid anywhere at 780, an open bid at 780, I'd be more than willing to take on more Agency. If it's not getting there, I think I might sell some $8 puts. As many as I can on that one. Not as liquid as I would like them to see, but anything under $8, I'm more than comfortable buying. Detailed video about Agency and ABR, which you announced, would be awesome. Well, Agency is done. ABR will be followed up probably in the new year. It had a good quarter, raised its dividend again. Love that little guy. The next one is going to be DHI. If you saw the earnings today, they're DHI up $4, $5 today alone. So let's figure out what it is that this home builder is doing that it's being rewarded so well. I think it's important to understand how DHI does have almost a mini REIT growing on its balance sheet because of its rental properties that it's building. So it has embedded within it a mini REIT, which makes it great because they can build houses that, if they don't sell, you can immediately turn them into a rental house, and now you have an investment property asset. And it's not like a car that depreciates over time. A house will only appreciate. So you have a rental asset that will appreciate over time. Let's put a couple of check marks on that one. Now that the Fed has been a bit more clear on the future path of interest rates, continue to go up, higher than expected, slower pace, do you think at this time would be appropriate to begin building a long position in the CD sector, consumer discretionary? Or is it best to wait until hike rate increases are closer to being over and the Fed has entered a wait and see phase? So we're somewhere over here. We don't know whether we have a soft landing or whether we're going to have a hard landing. Consumer discretionary tends to turn over before the market turns over. So there's S&P and there's consumer discretionary, and it tends to turn up somewhere near the turning point in the contraction. Certainly not in the early contraction. You still have the contraction to get rid of. What we're looking for here is negative data that is getting less negative. So I'll just put negative D for negative data, and it'll accelerate. You'll have accelerating negative data, then you'll have decelerating negative data. When it starts to decelerate is when you step into consumer discretionary. I think now would be premature. In my view, it's almost a certainty at this point that we will have a Fed-induced recession. Then you would want to stay away from CD at that point. However, because we are in the early contraction, then we could reasonably expect that the market is close to the bottom. Late contraction. To gain more insight on how I would build my position, being Canadian, not wanting U.S. exposure, I'd use synthetics. Good. 4 quarters out and build a position 1/3 at a time. 1 quarter per 1/3, 1/3 in January, 1/3 in April, 1/3 in the summer. My first trade would be around 0.3 delta. 0.3 delta for a synthetic. A synthetic is one, not 0.3. So I'm not sure what you mean by building a synthetic at 0.3. Do you mean using 0.3 calls or 0.3 puts? 0.3 puts imply 0.7 calls, right? But I'd be more aggressive at the second and third trade if the market increased further. Well, these are not synthetics. Do you mean selling puts? So here's the way I would look at it. Let's say CD is at 145. And I expect there to be a significant pullback. I might look at 110 for, let's say, March. And I might say, well, 110 might be an interesting point. I'd sell a put here. I'm not going to get a lot of money for it, but it's so far out of the money, it's not going to cost me a lot of margin. And let's say that I get 70 cents for that. And it does get to 110. Well, when it gets to 110, the call is going to be really cheap, right? So then I now have a synthetic. I can then add the call, and I now have a synthetic at 110. If it gets, as it approaches 110. I just think it's too early. So trying to design something in consumer discretionary, I'm just not seeing it. I would be probably selling calls on this one before I would be selling puts. But if I were going to sell puts, I'd probably sell the March put 110, and then I would go the same distance out and I would sell a call over here to get twice the premium. Whatever that premium happens to be, I'd probably be using March on that one. If my plan was to build a synthetic position, I would get my put first and then wait for my call position to come into play. Or I would just avoid it altogether and wait. Probably is what I would do. CD's not even on my radar right now. I'm just not seeing that there's a lot of interest in that. You have Tesla, which is a big holding, and it's been dropping. It's under 190 now, 188 last I saw, which pre-split levels is what? Under 600 bucks. It's 560 something, 564, 568 on a pre-split. Could drop below 5, which means on a post-split you're at 188. I've seen a price target of 130 on it in near-term pressure to get there. That's going to just drag down consumer discretionary because it's a big holding. So you have to look at who the two big holdings are on that one, Amazon and Tesla. Although I don't know that they make up that much anymore, but they did. They made up a big part of it. If Tesla's got some downside to it, because it is still a very high forward multiple stock, it could come down a lot and still be considered to be overvalued for the sector that it's in. I guess my short answer here on this is I just don't see that it's time to even consider consumer discretionary, and if I were going to use it, I would be more likely to sell calls on it than I would be to sell puts on it. Okay, this last screen here. Do you see the risk of a lost decade? No, I never see anything lost. I see lost decade if you're thinking in terms of just recovering the index, if you just a passive buy and hold, but lost decade for who? If I buy if the market goes down to 32 and I buy and it takes 10 years to get to 48, that's not a lost decade for me, right? So when we say a lost decade, it's for who? I don't know that anybody actually experiences a lost decade unless you bought the index at 4,800, rode it all the way down and waited for it to get back to 4,800, received no dividend and didn't invest no dividend. There's a lost decade, sure, but I don't know that anybody actually experiences a lost decade. Some analyst in Bloomberg was saying this yesterday. I think you proved one time that all the 2000 seemed like a lost decade. You actually had single-digit returns when you consider the dividend and selling calls at 16 delta. Yeah, because you have the dividend, you're reinvesting the dividend. If you're just looking at a price return, it's easy to say, okay, well, look, at 2000, the index was at 1100. At 2010, the index was at 1100. That's a lost decade. Yeah, but you had dividends and the index went up and it came down. I mean, you're going to rebalance. You're not just going to hold. You're going to say, well, let's lighten up here. Let's take our dividend, reinvest it somewhere else. There's no lost decade in that sense. That's only if you do nothing altogether. Do you see this risk in the future? No, I don't. Not 100% sure I got it right. You mentioned that returns and GDP will be single digits for U.S. Well, GDP would be rare that would see double-digit GDP. It's always single-digit returns. Single digit for the U.S. for the next years. That's the thinking. Is that I don't know that I would be too eager to accept it, but it seems to be the consensus that you will have those kind of returns going forward without central banks around the world pumping liquidity out. If yes, what about the so-called 60-40 portfolio, but 60% SPY, 40% XLP? Well, XLP is already in SPY, so you go XLY, 60% discretionary, 40% staples, combined with selling 16 delta calls every month. Yeah, I can do that, but over a 10-year period, a 60-40 that's XLY, XLP did outperform just SPY on its own, but just a little bit. Not really a lot. It did outperformed, but it outperformed a little bit with much lower volatility. That's the big deal, is that the Sharpe ratio of that portfolio was much higher. And yeah, you could sell 16 delta calls, but in a bull market, I don't know that I would be too eager to sell calls. I think the money would be in selling puts, and more aggressive puts, 40 delta puts, 30 delta puts, because if the market is going up, selling puts, if the market's over here, selling puts makes a lot more sense to me than continually selling calls, because what if it gets called away, gets called away, gets called away? I may miss chunks of this return. I'd be more likely to flip from, you want to sell calls when you think the upside isn't going to get there, when the distribution of implied volatility seems to be larger than the distribution of actual volatility. It makes sense to sell calls, especially on stocks that don't have those big growth rates. So if you think that, well, a stock will grow by let's say 1.5% on average per month, but the implied volatility assumes a much wider distribution, then go ahead and sell the calls. But the premiums would be richer and better on the puts behind the market, especially on XLY, because it's more index-based. You'll have richer premiums and you can get a higher delta put that's safer if the trend is this way, right? Let's see. Have you considered buying 6-month Treasury bonds? Nope. Very short term. If yes, can you tell me how to buy them? On Interactive Brokers, on your top menu, this is your screen. You have a whole bunch of icons up here. There's one that looks like kind of like sort of a coat of arms that looks like this further down here, and it says Treasuries. Go ahead and click on that, and you'll get a window open which will allow you to select what it is you're looking for in terms of the tenor, the issue date, or the maturity date. All of that stuff you'll be able to get. It just should be an icon right at the top of Interactive Brokers. And that'll take care of it for this week.